Hi there, Shingwa here again with another update on portfolio performance over the past week. On a one-week basis, 5 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from CBAM 1v2 returning 0.66% down to CBAM 5 returning minus 0.04%. We did see a bit of a week where we saw a rally in longer duration assets and also longer duration equity assets, inclusive as investors took bets that the major central banks would begin a rate cutting cycle sooner than expected in 2024 on the back of inflation coming down in major economic areas and also some slower than expected economic growth, especially in the Eurozone, moving the needle really to point towards more sort of dovish approaches from the ECB, and you'll see that strong performance in longer dated European government bonds, returning 1.84% on the one-week basis, alongside US Treasuries, returning 1.59%, then longer maturity equity positions as well, through ADM Global Focused, returning 0.85%. In terms of detractors from performance, we continue to see that those headwinds we've been highlighting over the past couple of weeks for Hypnosis Songs Trust, with the latest news breaking up as well of that they would be facing some legal action around some earnings that were diverted from the former Hypnosis Songs Management Limited, and that would see that lawsuit being raised there, and also being some further negative news after we heard that they would be cutting their dividend for the rest of the financial year in order to maintain a covenant on interest rate cover for their revolving debt, and that would see them down 3.65%, alongside some headwinds that we well know and have been discussing for the past couple of months for China, with Colombia Threadneedle down 2.78%, alongside HSBC MSCI China down 2.73% as well. Quarter to date, 1 out of 10 of the CBAM portfolios outperformed its respective benchmarks, with returns ranging from CBAM 3 returning 0.55% up to CBAM 1v2, really being driven by that global bond rally, returning 2.04% on a quarter to date basis as well. But we also saw some interesting performance in terms of risk on assets, with the S&P 500 hedged position returning north of 7%. But also notably here, we've been seeing some broader dollar weakness, with the US dollar down 3.4% versus sterling on the quarter-to-date basis, and really driving that return of the S&P 500 hedged position. And then we saw some strength as well from European Continental through Allianz Continental European Equity, up 6.35%, as we saw again an environment where you've seen a more sluggish GDP growth in the EU region and weaker sub-50 composite PMI and services PMI in contractionary figures. And also we're beginning to see signs that double-figure inflation that we saw in Europe, driven by the energy crisis, this time around will be beginning to abate, and investors really making those bets that the ECB will have a bit more room to begin to lower interest rates faster than other sort of central banks around the developed world. Vanguard European government bonds, as a result, also performing well, 4.24% on a quarter-to-date basis. And then, as I highlighted earlier, we continue to see headwinds for our Chinese equity positions, with Bailey Gifford China down 6.82%, alongside MSCI China, through HSBC down 6.4%. But with the backdrop for China, obviously some improvement on the geopolitical front with the recent summit with the President Xi Jinping and President Biden in San Francisco. And then we also saw in Beijing just this week, China hosting the two leaders from the EU, hoping to improve sort of bilateral trade agreements. And we did see some improvement in services PMI, alongside exports, though a detraction in imports, indicating some weakness in consumer demand, but overall trade balance heading positively there for China. So hopefully that would be some tailwinds for Chinese equity looking forward over the next couple of weeks. And then finally, I think the biggest driver that we're really looking forward this week has been that jobs data coming from the US, which will ultimately determine the Fed's interest rate path in the coming year, and that would see unemployment expected to come in tomorrow, being Friday, at 3.9%, and a gradual move upwards of initial jobless claims as well, after the JOLTS survey, which is the Job Opening and Labour Turnover Survey, indicated less job openings, 8.7 million added just in the past month, and then also trade balance deteriorating somewhat in the USA, but really sensitive point around the unemployment data and initial jobless claims coming out tomorrow, which will determine the path of equity and bond markets going forward.